session of AIMA's Popular Leaders Speak series. We started the series just after the lockdown, and we have managed to complete 30 great sessions. So it's quite a landmark today for us. We are privileged to have with us one of India's very distinguished business leaders and Vice Chairman and CEO of India's iconic housing finance company, HDFC, Mr. Keki Mistry. Mr. Mistry, many thanks for agreeing to do this session and for presenting your perspective on the developments in the economy and the housing finance sector. It is a pleasure to have you with us and a very warm welcome to you. I'm also delighted to welcome Mr. Pati Singhania, Vice Chairman and Managing Director, JK Papers Limited, in his new avatar as President AIMA. Mr. Singhania, a warm welcome to you and many thanks for joining us to moderate this very important session today. It's great to have you on board. Ladies and gentlemen, before I hand over to Mr. Singhania to conduct the session, a few words to introduce Mr. Mistry, although he really needs no introduction. Mr. Mistry is one of the foremost CEOs in the financial sector. A chartered accountant by profession, he has worked with AF Ferguson Limited, Hindustan Levers, and Indian Hotels Company before joining HDFC. He's played a central role in HDFC's evolution as a finance powerhouse and was involved in the creation of the HDFC Bank and the group's foray into asset management and insurance. He's a valued member of the boards of many companies, including TCS and Torrent Power Limited, and is on the advisory board of a few Indian companies. He's also on some key committees of SEBI. Mr. Mistry has been a consultant to the Commonwealth Development Corporation in Thailand, Mauritius, Caribbean Islands, and Jamaica, guiding the companies to review and evaluate the operations of mortgage financial institutions in these countries, and also to Mauritius Housing Company and Asian Development Bank. He's been showered with numerous awards by national and international organizations, really too many to go into just now, and associations including Best CEO, Best CFO, Best Independent Director, and many more such awards. He's been an outstanding ambassador of Indian business at the international stage. My association with Mr. Mistry began in 2014 when we were on the board of Sun Pharma Industries together. And I must say, I have learned a lot from him, and it has really helped me in the years following. Thank you so much, Mr. Mistry, for accepting my request to join us for AIMA's Leaders Speak session today. It's really nice to have you on the AIMA platform after, I think, a long time. With these words, it is my pleasure to invite Mr. Pati Singhania, President AIMA, to take over and conduct the program. Thank you.
Thank you, Rekha, for those kind words.
Thanks, Rekha. Mr. Keki Mistry, Rekha, past presidents and council members of AIMA, ladies and gentlemen, all of you who have joined us. It's a pleasure to have you with us for yet another edition of AIMA's now popular Leaders Speak program. Mr. Mistry, this was actually this is a very popular program. We started out in the COVID times and and we had outstanding people that came in. So in today's interaction, ladies and gentlemen, you don't have just a new guest, you actually have a new moderator as well. This being my first major event after taking over as President AIMA, it is really my privilege and honor to conduct this dialogue with a very distinguished and successful business leader, Sri Keki Mistry. And I hope that all of you will find this and the coming leadership conversations as interesting as they have been for the past 6 months. Mr. Mistry, welcome again. It is indeed a privilege to have you on the AIMA platform. And I am lucky that I have you as the first guest that I welcome now. And thanks for agreeing to share your thoughts on the economy as well as on the housing finance sector. Now, as CEO of India's leading and most successful private housing finance company, and as an expert on housing finance, real estate and infrastructure sectors, you have a finger on the pulse of the economy. We want to understand from you how you think the economy is recovering And where do you think it is heading in the short and medium term? I know there is a bit of crystal ball gazing, but we will certainly want to understand what your crystal ball says. We also want to know from you about the coming changes in the housing finance sector and what those mean for our country's economic growth and financial stability. Ladies and gentlemen, the Indian economy is now beginning to show some signs of an uptick as unlocking is progressing with greater certainty and people are coming to grips with the COVID situation. Economic activity in most parts of the country has moved up and has got close to pre-COVID levels in several cases. Though the forecasts for the current year remain grim, the economy hopefully should return to some degree of normalcy next year. After a disastrous first quarter in the financial year in which the GDP shrank by 24%, recovery has gained momentum in September. The headline numbers in terms of the PMI of the manufacturing sector has rebounded, GST collections have improved, and movement of interstate road cargo has grown sharply. NBFCs and housing finance companies, I believe, are also witnessing significant improvement in collections. However, ladies and gentlemen, I think it is too early to celebrate. The recovery will face challenges because of the financial impairment of government, businesses, and consumers. Both the center and states are constrained in spending because of loss of taxes during the lockdown. Most businesses would perhaps carry the scars on revenue and profit loss for at least a few quarters. Consumption would be constrained by loss of income and confidence. And most importantly, financial stability would be a concern because of a big jump in government and corporate debt, as well as the worsening NPA situation. The government has tried to do things to stabilize the economy through a stimulus package and a bunch of reforms. The RBI has also announced several appreciable measures, and I think they have been very proactive in their response. But as you know, reforms take time to be accepted and implemented. Yet, the efforts to improve regulation must continue to improve the capacity and trust in every sector, especially in the financial sector. The housing finance industry is both an indicator of the state of the economy and also a driver of economic growth. And it needs RBI's help in absorbing COVID's impact and becoming fit for immediate and long-term growth. RBI, which took over the housing finance regulator, took it as mantle last year, has already proposed a slew of regulatory changes which could perhaps transform the industry. Just today, as I understood, the RBI has announced that all new housing loans sanctioned till March 31st, 2022 will now be only linked to advance to loan or the LTV ratio. This gives headroom for individual buyers on things like down payment. I will not say anything further because you want to hear Mr. Mistry, and we are once again privileged to have him tell us about the linkages between the economy and how the housing finance sector would work and what the RBI can do. Mr. Mistry, it is now my pleasure to invite you to share your thoughts with us. Thank you indeed.
Thank you very much, Mr. Harsh Singhania, Rekha Sethi, members of AIMA, and all participants. First of all, let me wish all of you a very good evening and all the very best in these difficult times. And thank you very much to AIMA for inviting me. I will divide my talk into two parts. I will begin by giving you a sense of the way I see the economic situation both globally and in India, followed by the current developments in the housing and in the real estate sector. In one of the most unprecedented events of our lifetime, the COVID-19 pandemic has unleashed a macroeconomic earthquake in its wake. The sheer scale and speed of the unfolding human tragedy is overwhelming. Personally, I never imagined in my wildest dreams that a virus outbreak of such gigantic proportions would happen in my lifetime. It threatens to leave a permanent emotional and psychological scar long after the crisis is over. The rumblings of the pandemic began in December 2019, or at least that is when we first heard of it. But like other epidemics in recent memory, it was thought that the spread would be limited and a cure would be found soon. For instance, epidemics such as SARS and the H5N1 avian influenza that occurred in the early 2000s each had an impact of just 0.1% annual GDP loss to the global economy. It is estimated that the total fatalities from both these global epidemics was just over 1,000 lives. COVID-19 is different as the transmission is faster and it transmits through carriers who don't show any symptoms. The economic costs too are extremely difficult to comprehend. Almost all economists are unanimous in their view that the COVID-19 crisis is far worse than the financial crisis of 2008. Global GDP is expected to contract by 4.9% in 2020 before rebounding by 5.4% on a lower base in 2021. Of course, the rebound hinges on the assumption that the health crisis will be contained along with the pace of the vaccine development and its distribution. No statistical model was able to predict the sheer scale and speed of this crisis. IMF has stated that the COVID-19 pandemic has had a higher negative impact on both economic and day-to-day activity than what had been originally anticipated, and there is still a high degree of uncertainty in making forecasts. Globally, central banks have been at the forefront in responding to the evolving crisis to ensure systematic financial stability. Central banks have adopted massive quantitative easing programs, offered loan moratorium, devised schemes to keep small businesses afloat, and many have been buying assets ranging from mortgage-backed securities, corporate bonds, municipality bonds, and even junk bonds, just to infuse liquidity into the system. As regards India, as you know, we enforced an extremely strict lockdown from March 25th up to the end of May. The economic cost of the lockdown, which began on March 25th, has been enormous, with certain sectors such as agriculture, airlines, hospitality, real estate, and retail being significantly impacted. India's GDP grew by 4.2% in FY20 against the earlier estimate of 5%. The fourth quarter GDP grew by 3.1%, reflecting the impact that the first week of the COVID-19 lockdown had. Hence, I am not alarmed by the 23.9% contraction that we saw in the first quarter GDP numbers. For most sectors, 2/3 of the quarter, and in some cases even a little more than that, were actually lost in the lockdown. India was amongst the very few major economies which imposed such a strict lockdown. Growth for FY21 is likely to see a contraction. Estimates currently range between 6.5% negative growth to 10% negative growth. It is important to reiterate that India is not an outlier with its GDP contraction, and something like this is what you would probably see in almost all countries all over the world. I don't know about China, but other than that, in most other countries, you will see that. The government is acutely aware that India cannot afford another lockdown, and hence the easing out measures that have taken place have been done in a very phased manner so that things settle before you do more opening up. As regards corporate India, the overall performance during the first quarter of 2020 was weak, as expected. The weak performance was led by manufacturing companies, while service sector companies, especially those in the IT sector, remained in positive terrain. India Inc. is hoping that demand picks up as the lockdown measures continue to ease. We have clearly seen signs of this in the July to September quarter. In fact, in several businesses, the month of September 2020 showed a growth over the corresponding previous year's September 2019, clearly showing that the worst is behind us and the recovery is a lot faster than what was earlier anticipated. Currently, we are witnessing an improvement in the Indian economy on a month-on-month basis, and we can expect, at least I would expect, that by the end of the December quarter, the economy, by and large, will be close to the pre-COVID levels for most businesses. In fact, in some sectors, the quarter ended December 20 is likely to show a growth compared to the quarter ended December 19. And this, frankly, is a little faster than what I'd originally envisaged. In April and May, when we spoke to a number of investors, in March and April, not even so much May, when I spoke to a number of international investors, my belief at that time was that we would be at about 90 to, I would say anything from 85 to 90 to maybe 95% normalcy by the time we come to Jan to March. In reality, the way I see it now, we will see that we have already seen that normalcy in most sectors, and you start seeing a little bit of a pickup starting October. Some sectors such as e-commerce and agriculture have performed well during the lockdown, and there are clear signs of revival in rural demand, blue-collar jobs, as well as in the auto sector. Pent-up demand is expected to unfurl in the coming months. In fact, small towns are outpacing metros in consumption. These towns are witnessing good demand for electronics, cars, apparels, food, and two-wheelers in particular. The RBI on its part has been extremely proactive and has introduced a host of measures, including reducing the repo rate twice since March by 115 basis points to 4%. The previous instance when the repo rate was reduced to sub 5% was in April 2009 during the global financial crisis. The central bank has infused an estimated rupees 9.57 lakh crores or 4.7% of the nominal GDP so that corporates have enough liquidity and better access to working capital. To augment liquidity in the system, the RBI reduced the reverse repo rate, cut the cash reserve ratio, conducted targeted long-term repo operations, and introduced refinancing facility. Whilst RBI has done a commendable job in continuing with its accommodative policy, bank credit has not picked up the way one would have liked to see because there continues to be a certain amount of risk averseness in the system. Bank credit is hovering around 5.5% to 6% year on year compared to over 10% in the previous year. The risk averseness to a great extent is due to the uncertainty of COVID-19. To ease the financial stress due to the intense disruptions of COVID-19, the RBI has permitted banks and financial institutions to allow a moratorium on payment of installments for all term loans outstanding on March 1st, 2020, provided they complied with certain conditions. The extension of the moratorium was allowed up to August 31st, 2020. Now that the moratorium has ended, banks and financial institutions are closely monitoring the repayment of money from borrowers. There is still a lingering fear amongst lenders, fund managers, and investors about the moratorium's impact on the overall credit culture and whether consumers will be able to service loans post the moratorium. RBI has taken note of the fact that the economic fallout on account of COVID-19 has led to financial stress for a large number of borrowers across the board. The resultant stress could impact the viability of corporates with good track record as their debt burden has risen significantly compared to their cash flows. RBI has said that such a widespread impact could pose significant financial stability risks. Accordingly, RBI has approved a one-time restructuring plan for eligible corporate exposures as well as for personal loans. There is recognition on the part of the authorities that some sectors have suffered considerably more pain than others and would therefore merit a slightly different treatment to enable the recovery. To explain further, a loan restructuring allows lenders to reschedule loans and to reschedule repayment of loans or extend the loan tenor depending on the current repayment capacity of the borrower. There has been an ongoing debate on how much fiscal stimulus the government should provide. Some experts have suggested that since India has a government debt to GDP ratio of 68%, which is modest compared to other countries, it can afford to spend more to get the economy back on track. Conversely, the government is worried about rating downgrades, which increases the cost of borrowings, puts pressure on the rupee, and affects investor sentiments. So it's a fine balancing act that the government has to take. Fiscal deficit has already exceeded the budgeted target of 3.8% for FY20 to reach a 7-year high of 4.59%. Revenue collections are limited, and GST collections have fallen due to the pandemic. Tax collections too have declined consistently from 11.3% of the GDP in FY 2018 to an estimated 9.6% in FY 20. I do believe that India's pace of reforms needs to continue. Foreign investors need to be given the confidence that India is not headed for a structural slowdown. Sound regulatory policies and implementing structural reforms will help India attain a swift economic recovery. The manufacturing sector in India has been struggling. Manufacturing grew by a mere 0.03% in FY20 and recorded a negative 39.3% in the first quarter of the current financial year. Positively, COVID-19 has provided a huge opportunity for India to establish itself as a manufacturing base for the Western countries. Some of the positive signs that we see in the economy are as follows. Firstly, India's foreign exchange reserves are at a very comfortable level of US dollars 542 billion as of September 2020. This covers 14 months of imports, and India is now the fifth largest holder of reserves other than China, Japan, Switzerland, and Russia. India has been helped by low oil prices, which currently, as you know, are around $40 a barrel. India imports 80% of its oil requirements, and hence import costs will become a lot cheaper. India's current account deficit is steadily falling over the years. During FY20, the current account deficit stood at just 0.9%. In fact, India achieved a current account surplus of 0.1% in Q4 FY20 and 3.9% of the GDP in quarter one of FY21. We may expect a combined balance of payment surplus in the coming period to a great extent driven by lower oil prices. The rupee has performed well during this period and has depreciated by about 5 to 6% against the US dollar since January 2020. In this regard, India is much better off than other emerging countries such as Brazil, Russia, South Africa, and some other countries where currency depreciated in mid to high teens against the dollar. In fact, the Indian rupee has appreciated from 75 rupees dollar level in May to about 73 levels currently. During FY20, India received FDI of US dollars 49.98 billion, a 13% growth over the previous year. Over the past few years, India is progressing on the World Bank's Ease of Doing Business Index. Last year, India recorded a jump of 14 positions to be ranked 63rd. India's monsoon for the current year is expected to be normal to above normal. The Kharif crop cycle has not been much impacted by the crisis. Further, it is estimated that rural unemployment has come down thanks to Narega and Kharif sowing. Apart from the opportunities in the manufacturing sector, which I mentioned earlier, India has immense global opportunities in sectors like IT, back office, healthcare, fintech, and e-commerce. India is rapidly digitizing. India's digital economy is expected to be US dollars 1 trillion in 2025, when the total economy touches US dollars 5 trillion. That is 1/5 of the Indian economy will be digital. India has almost 700 million internet users and has immense potential to grow manifold. The high-frequency data, be it e-toll collections, e-way bills, digital transactions, two-wheeler, passenger vehicles, tractors, etc., all these have shown segmental improving trends. While the pace of recovery is still not optimal, these indicators show that the worst is probably behind us. And that is honestly my belief that the worst is behind us. Financial penetration in India is extremely low, which implies a huge potential for growth. The mortgage to GDP ratio in India is around 10%. In China, it is 26%. In the US, it is 53%. Other indicators include very low penetration in insurance. For example, insurance penetration in India stands at 3.7% of GDP. Malaysia, Thailand, China all have ratios which are closer to 5% of GDP. India's mutual fund penetration is 13% of GDP compared to 114% in the US and 73% in the UK. So all these factors are clearly pointing to the fact that in the years ahead, once we get to some degree of normalcy, the growth in the economy should continue. And that is really the reason why you're seeing so much of foreign investment come into India. Also, very importantly, we have favorable demographics. India accounts for 17% of the world's population, or 1 out of every 6 person in the world is an Indian. 66% of our population is under the age of 35 years. India's middle class is estimated to rise from 250 million individuals currently to about 800 million by 2030. India is a domestic consumption-based economy. Private consumption forms 60% of the economy. So the critical thing is to leave money in the hands of people. People will spend that money. Consumption will lead to demand. Demand will lead to manufacturers wanting to produce more, which will create jobs. Jobs will create more incomes in the hands of people and therefore more consumption. And that's how the economy should hopefully keep going. India is poised to become the third largest consumer market behind US and China. Consumer spending in India is expected to grow from US dollars 1.5 trillion at present to nearly US dollars 6 trillion by 2030. And lastly, there is no dearth of entrepreneurship in the country. India is the third largest ecosystem for startups behind China and the US. So that was on the economy. Let me come to the second part, which is on housing. As with several other sectors, the housing and the real estate sector too has been impacted by the unprecedented circumstances. I would like to point out that the real estate sector, like certain other sectors, was already under stress prior to the pandemic, and the crisis has only increased the stress. For some time, home buyers were adopting a wait and watch stance till the situation tended towards normalcy. However, we are clearly seeing that on a month-to-month basis, demand is picking up. In fact, at HDFC itself, our individual loan disbursements during the quarter July to September was at 95% of what it was in the previous year. In fact, for the month of September 2020, we recorded a 21% growth in terms of applications which we received compared to September of last year, and a 31% growth in approvals, and an 11% growth in disbursements over September 2019. And honestly, this recovery is a lot faster than what we had originally anticipated. These numbers are only indicative of the inherent demand for housing and an assurance of the sustained future. Improved affordability, together with the lowest ever interest rates on housing loans, coupled with stable to lower property prices, has shown that this is an ideal time for home buyers. Government support and rising incomes have contributed to improved affordability. To give you an example, our estimates show that this is the best period in terms of affordability in over 2.5 decades. Around 25 years ago, it would have taken something like 20 times a person's annual income to be able to afford to buy a modest-sized home in most cities in India. Today, in 2020, this affordability ratio has come down from 20 times to about 3.3 times, meaning it takes 3.3 times on an average a person's annual income to be able to afford to buy a house. I'm optimistic about the future of the housing sector, as demand for housing remains insatiable in a country like ours, which has a huge housing shortage. As I mentioned earlier, the penetration level of mortgages in India at 10% is extremely low compared to almost all other countries, barring Brazil. Housing is a basic necessity and not a luxury. Most middle-income people who take loans to buy a house are genuine end users and intend to stay in the house. Also, apart from extraordinary circumstances, my experience has shown that housing has proved to be inelastic to interest rates or slowdown in the Indian economy. The structural demand for housing in India will always be strong due to factors such as improved affordability, government's trust on affordable housing, favorable demographics, increasing urbanization, and rising aspirations. 2/3 of India's population is below 35 years of age. And unlike what you see in the West, in India, people do not buy a house when they're in their 20s. So the average age of a first-time home buyer in India, from our experience, is somewhere between 37 and 38 years. And with 2/3 of the population being below 35 years, what that clearly means that 2/3 of the population has not even contemplated buying a house. has not even thought of buying a house. But over the next 5, 10, 15 years, as all these younger people get to an age where they will need to buy a house, my sense is there will be a structural increase in the demand for housing and therefore housing finance in India. To my mind, and as I mentioned earlier, this is one of the best times to buy a house. Interest rates are at an all-time low, and certain states have provided time-bound relief. For example, Maharashtra has lowered the stamp duty rate to 2% if the property is registered before 31st December, a reduction from the earlier rate of 5%. RBI has introduced several measures during the past few months to alleviate the stress of the housing and real estate sector, such as liquidity infusion to housing finance companies, partial guarantee schemes, and refinance facilities. Importantly, the real estate sector was one of the 26 sectors that was approved by RBI for the one-time restructuring plan. So why is the real estate sector in particular undergoing such severe stress? And why are a large number of real estate companies that otherwise maintain a good track record facing the challenges of the debt burden becoming disproportionate relative to the cash flow generation? The real estate sector has been facing challenges, I would say, since 2017, so from a little over 3 years. And the primary reason is that the demand for under construction properties has slowed down significantly. Now, whether this is because people want to see the property, see that it is ready before they buy it, or it is because of the GST on under construction properties, which is not there on a ready property, one would never know, but there are different reasons why there is a slowdown. Historically, a large part, or at least some part, I won't say large, but some part of the funding for a project used to come from sale of property whilst the construction was going on. However, in the last couple of years, the demand for under construction properties has slowed down, and therefore the last mile funding that developers used to get to complete the project, which used to come from sale of under construction properties, they are no longer getting. And that is the reason why you see some projects, particularly in the big cities, which have come up to 70, 80% levels, but are not getting completed. Lenders are reluctant to lend money to these stressed projects due to the fact that any fresh funding would be classified as a non-performing asset on day one in the books of the new lender. Such stuck projects become unviable as interest costs continue to mount. Due to these factors, last mile funding that developers used to get from the sale of under construction properties has reduced significantly. Consequently, we have seen projects in big cities being stuck. There are several home buyers who are in a dilemma because they booked apartments in these projects, and these projects are not getting completed because they are not getting that last mile funding. In the context of the aforesaid, RBI's decision to allow a one-time restructuring of loans will give confidence to banks and financial institutions to provide that last mile funding which is required to complete the project, or so one hopes. The government recognizes the critical role that housing and real estate plays in the Indian economy. The housing and real estate sector is an important component of the Indian economy, contributing 6.4% of the GDP. It is also the second largest employer in India after agriculture, and it has backward and forward linkages to over 270 industries, the large ones being cement and steel and paint and so on. These industries in turn contribute to capital formation, generation of employment, and income opportunities. The real estate sector, more than any other sector, catalyzes and stimulates economic growth. For economic revival to take place, job creation is critical. As the real estate sector creates jobs directly and indirectly, there is a need to support the sector. According to India's economic survey of 2017-18, nearly 90% of the workforce employed in the real estate sector and construction sector are engaged in the construction of buildings. Over 80% of the employment in the real estate and construction sector constitutes minimally skilled workforce. Further, the sector is expected to require over 66 million people by 2022. Housing is one of the largest employment generators in the economy, both in terms of direct jobs and the job it creates through the ancillary industries. Steps such as the one-time restructuring of loans and other measures will help in stimulating confidence in the economy and allow the real estate sector to come back strongly, which can then catalyze the creation of jobs. At a broader level, I would like to stress that India will fully recover and achieve a sustainable long-term growth rate only if we create jobs. This, I feel, is one of our greatest challenges. It is estimated that India needs to create 10 million jobs every year till 2030 to reduce the unemployment. The availability of jobs currently is not even half that number. Apart from real estate, India needs to also focus on sectors that are job machines, such as infrastructure, manufacturing, and labor and knowledge-intensive services sectors. The creation of jobs will in turn generate income, increase consumption, result in greater demand for goods and services. Job creation will increase aggregate demand and eventually lead to higher economic growth. Thus, the confluence of all these factors will help, in my mind, in reviving the Indian economy. I would like to talk about a couple of trends we are witnessing in the housing sector. Due to ongoing reforms and incentives, the housing and real estate sector has become structurally stronger over the years. For instance, the affordable housing segment has become a sweet spot for every constituent across the housing chain, as the segment has been hugely incentivized by the government. The focus is on increasing the supply of houses at affordable price points to facilitate poor and relatively lower middle income people to buy a house. Within the ecosystem of Housing for All agenda of the government is the credit-linked subsidy scheme, which has been a major success. In this scheme, the interest subsidy on the home loan is paid to the beneficiary upfront, thereby reducing the amount of the loan and consequently the AIMA. The upfront subsidy under the CLSS goes a long way in enabling individuals to become homeowners much earlier than was the case earlier. The government's trust on housing is a recognition that a rapidly growing country like India, with a large young population, needs more homes at affordable price points, which would enable more households to become homeowners. Another trend we are witnessing is the increasing focus on rental housing. Various attempts have been made to increase the rental housing stock in the country, as there is recognition that mature housing markets have a combination of rental housing and home ownership, and that people need options to move across the housing ladder. The government has introduced the Model Tenancy Act, which aims to balance the interests of both the tenants and the landowners. It is estimated that in urban India, there are over 11 million vacant houses as people fear giving them on rent. A formalized rental market will reduce the skewness on more vacant houses, and hopefully more vacant houses will get occupied. Let me now conclude. I hope and pray that we will soon see the end of COVID-19 pandemic and that our lives will come back to normal. Offices, shops, and malls are slowly opening up. And although there is no vaccine or established cure as yet, many people are going ahead with their day-to-day lives, although with a lot of precaution. Over the past decade, India has endured several crises, such as the global financial crisis of 2008-9, the US Fed's taper tantrum in 2013, and the ILFS default in late 2018. The common thread across all of this was that it created an atmosphere of risk aversion. But regulatory measures and the inherent strength of the Indian economy with its strong fundamentals led to recovery. India has proved to be a resilient economy. In a post-COVID-19 world, India will be able to climb back the growth ladder. The main reason for my optimism is that India is a strong domestic consumption-based economy. And penetration levels are so low in India that the scope to grow remains high, so long as we create jobs and so long as money is left with people. I do believe that there is light at the end of the tunnel. When this is all over, we will look back and not be able to believe that such a scenario ever happened. It is often said that India performs best in a crisis. The pandemic may just become a catalyst to bring in further reforms to ensure India's sustained long-term growth. Thank you very much. I don't know if I've exceeded my time, but thank you very much.
Thank you, Mr. Mistry. Thank you very much for your comprehensive remarks on both the economy and how you see it shaping up, as well as on the housing finance sector. Indeed, very insightful comments. We have a large number of questions which have come up through the chat, as would be expected from your remarks and from a person like you. There are so many, but I'll try and club some of them. And so broad themes, you talked in terms of saying that, we have the resilience to come back. You talked of the positive sides, and yet you've emphasized the whole issue of criticality of job creation. So some questions are around, job creation as to how that might happen. And also linked with that, if I may, the apprehension that if jobs have been lost due to the lockdown, which is the fact, how will people be able to repay things like home loans and other credit? And, how do they get out of that cycle? So let me start by asking that first, because there are two or three themes linked in here.
So let's first talk about people losing jobs. First, we talk of job creation, and then we talk of people losing jobs. Job creation, to my mind, is the single biggest catalyst that we need for growth. We cannot grow, the economy will not grow, we will have social problems unless and until we, over the next 2, 3, 4 years, set up a mechanism through which we create jobs on a regular basis. So what we really need to do is identify, and I'm sure there is so much knowledge within the government that they know that identify the sectors which are job machines, which create these jobs, whether it be real estate, whether it be manufacturing, whether it be agriculture, whatever it is, and then understand what are the issues, what are the bottlenecks, what are the problems connected with that sector, and try to address these sectors. If we can do that, to my mind, we will create the jobs that are required. Your second question was on people's ability to pay back the loans because of job losses. Look, I mean, I can tell you from our experience, and I speak to a number of banks. So, whilst there may have been fair amount of job losses amongst the migrant workers and at the very low income levels, generally speaking, from what we have seen, and this is after discussing not just looking at our numbers, but also looking at also talking to various other banks and financial companies, the job losses for people who borrowed money has not been as alarming as the media would like you to believe. My honest view is that there are job losses. Of course, there are job losses. You keep getting letters from customers saying, I've lost my job, I don't know what to do and stuff like that. But it's not that large a proportion of the total loans outstanding in the system. And the restructuring which has been permitted by RBI, my sense is that most banks, and this is again a guesswork at this point of time, but most banks will find that anything between, I would say, 2.5% to 4% of their total individual loans will come up for restructuring. And that 2.5% to 4%, maybe 4.5%, probably on the higher side, is what probably tantamounts to the job losses that you're talking of. So it's not 10 and 15 and 20%. To my mind, it is going to be single digit, and that too probably sub 5%. So it's not that bad a situation. Our experience, if you take the example of 2008, 2009 also, there were job losses, probably less than what you've seen in this current pandemic. But even in 2008, 2009, we saw that in the short term for a couple of quarters, NPLs across the banking system tended to go up. But once we got to some degree of normalcy, NPLs started coming back to the levels that used to prevail prior to the crisis. To give you specific numbers, if you look at August 2008, that is the time when the crisis first started hitting India. And it started with foreign money flowing out, equity markets getting impacted, and then a whole host of negative factors which came in at that time. The regulatory response at that time was very swift. RBI cut rates dramatically. We saw 50 basis points, and if I recall right, even a 75 basis point cut in rates at some point of time during that 2008-2009 period. And NPLs across the banking system went up. By the time we came to May, June, maybe July of 2009, things started getting better globally and to a great extent, to an even greater extent in India. And by the time we came to December 2009, the economy was back on track, growth was back on track. And we saw in our business, for example, that the quarter January to March 2010 saw the fastest percentage growth that we have seen in housing loans in our lifetime, in our history, that quarter, in percentage terms. That was possibly because the previous year's Jan to March quarter was weak, but I think it was also facilitated by the fact that a lot of people who could, who either because of sentiments, because of job losses, because whatever reason, did not purchase a house during that earlier period, did so during that quarter, particularly seeing that house prices were beginning to rise. So the Indian economy, I believe, is resilient. I understand this is a more severe problem than 2008, 2009, but my personal belief is that we should get back on foot. And whilst NPLs will go up, are likely to go up, it is not, to my mind, going to be that dramatic.
Thank you. Now, while there are many more questions, I see a couple of past presidents here. So maybe, Rekha, if we could get our administrator to unmute, for example, Mr. Saraugi, we could ask him if he has a question to be asked. He is the senior most past president here. Could you unmute him, please?
Sagar, can you unmute Mr. Saraugi? Mr. Saraugi?
Is he there still? I saw him earlier on.
He was there.
Okay, it doesn't matter. Then we can move on to some other people here. I saw Mr. Rajiv call here. Rajiv, would you like to ask a question?
He was actually logging in from London. I think he dropped out.
Oh, has he?
He had a connection problem.
Okay. So that's the kind of fan following you have, Mr. Mistry. People logging in from overseas. So anyway, I also see our immediate past president, Mr. Sanjay Kirloskar, though he told me that he didn't have any question, but maybe from what Mr. Keki Mistry has said, something has stimulated his mind. Sanjay?
Yeah, if I could say something, our economy was already slowing down before COVID. And so I was very happy to hear you so upbeat about the future after all that has happened. And that, that the September quarter in many sectors is as good as or better than September last year. And you're expecting that the December quarter will be much better. So after that, at the end of the first quarter, people were saying that there's a 23% drop in our GDP year on year. And people are projecting that now it will be about 12% or something like that. Do you expect it to be actually far less than that, the drop?
See, these are arithmetical numbers in my view. My personal view is that we should end up at 10 or just a little below 10, but this is a one-time event. I would expect the economy to bounce back in the next quarter. This is more arithmetical than anything else. It's more arithmetical because your first quarter was a complete washout, and the second quarter has seen recovery, but not 100% recovery everywhere. So therefore, there will be an impact. Whether it is going to be 9%, 10%, 11%, these are frankly numbers. Whether it is 9% or 10% or 11%, to my mind, is not going to make a material change anywhere else. I think what we need to do, and I'm suggesting something which is a little, I would say, untraditional, if I may. I would say that, of course, job creation has to be priority number one. Priority number two, to my mind, should be to leave money in the hands of people. The way we can get the economy out of this present spot is to get consumption going. Consumption has to pick up. So it can pick up either to creating jobs or leaving more money in the hands of people. And leaving more money in the hands of people means lowering tax rates. Now, that may not be a very favorable sort of a suggestion at a time like this when there is a fiscal deficit and the government's trying to raise resources from everywhere. But I think the long-term benefit that one would get by lowering the tax rates for individuals, the cost, to my mind, is not going to be that high. That's my view. You will not have a very high cost. But the benefit you will get in terms of getting more consumption and therefore more jobs, more people spending money, more demand for goods and services, companies producing more, hiring more people, that benefit will far outweigh the little loss that you may have in revenue. That's my personal belief. And whilst the corporate tax rates have been cut to probably the lowest level we've seen in a very long time, and very rightly done, individual tax rates have actually gone up. So from a peak tax rate of around 34-35%, you are now looking at a 44% peak tax rate. And because of that high tax rates, you do find that people grumble about it. People find ways and means of not showing their true income and stuff like that. So we need lower tax rates and we need much better compliance. That's my view.
So in the long term, thanks to our demographics and the young age of our population, you see that, when we look back 3-4 years from now, it will look like, and I'm not an economist, I'm an engineer, but you think that we will look like what people call a V-shaped, recovery, where, thanks to job creation or the growth of the population, the growth of everything else, we will get back to the track that we were on.
I absolutely think so, provided, of course, that we create jobs. The demographics that we are talking of can be a massive advantage for us. But if we do not create jobs, if we are not able to create jobs, then it can also be a disadvantage because you can lead to social issues and things like that. So therefore, my personal view would be is that the biggest focus area has to be on job creation and what we need to do to create jobs.
Thank you. Thank you, Mr. President.
Thank you, sir. Thank you, Mr. Mistry. And if I may just add my 2 cents worth or 2 paisa worth, I have personally also sort of believed and have been, upon government this thing that you talked in terms of leaving money in the hands of people, because we desperately need to create demand. We know the challenges are there. And you talked about the high fiscal deficit, but we need to be bold at this point. And sound economic theory is one thing, and one respects that. But here we are talking about stuff on the ground which needs to happen. And so really this is very sound advice, I would say. And you are re-emphasizing multiple times the criticality of the jobs, because otherwise who's going to consume and how will we do this? May I turn to another question that came up, which is some people are asking, someone has asked about the future of renting houses in India. Do you have a view on that? Do we see that accelerating, decelerating? How would that pan out?
The government's trying to encourage rental housing by having this model act for rental. Today, what happens is rental act is determined by each state. So each state is going to have different rules as far as rented property and things like that are concerned. There is still a lot of reluctance on the part of people to rent out their property. One, because these properties that are rented out are typically rented out for 11 months at a time, and some cases 3 years at a time, not more than that. And you run the risk of the tenant not leaving the flat when you want, or leaving the flat in a bad shape, or messing around with the flat and things like that. So it's not a preferred option for people. It is beginning to pick up, but these are very, very early days. Given where we stand today compared to that, yes, one can see more of rental housing in the days and months and years to come. But at the moment, it is at a very, very low level. People want to live in a house. They want to buy a house to live in and not stay in a rented house, by and large. Unless and until you're a person who's got a transferable job and you're based in Bangalore and you're working in Mumbai or Delhi or wherever. And therefore, you're looking for a rented property there.
Right, thank you. Mr. Raju Kanodia, you want to ask a question? Can we unmute him?
Well, Harsh, I was requested to unmute. Not that I was preparing to ask a question, but since you have asked me, I thank you so much. I've really, enjoyed the optimism that Mr. Mistry has conveyed in this session, and I think it's very encouraging to listen to him. I have just 2 questions. One is that we all talk about a recovery, which seems that, we are talking about an across-the-board recovery, but there are still some sectors which are extremely stressed out. I mean, travel and tourism, for example, and hospitality. And, this concept of a V-shaped recovery or a K-shaped recovery, I mean, do you really believe in an across-the-board recovery, or do you believe that some sectors would continue to remain stressed and they are large employment generating sectors which will get affected? Second point I have, sir, I'm sorry,
Yeah,
is
sure.
that you mentioned that the Indian rupee has performed extremely well as compared to other currencies in countries like Brazil and so on. I mean, do you really believe that the performance of the Indian rupee or the appreciating Indian rupee at this point of time is really going to help the Indian economy? Because I fear that we are going to get into a Dutch effect, really, of becoming more and more uncompetitive, and that will probably have a long-term impact on the Indian economy. This is my personal view. I mean, I may be completely wrong about that.
All right, so let's come to your first question, which is certain sectors getting impacted. Yes, certain sectors have got far more impacted than other sectors, and you mentioned travel and tourism and hospitality. Absolutely. Hotels are opening up. Restaurants in Maharashtra, for example, are opening up, I think, from the middle of this month. There is obviously going to be a lot of reluctance or a lot of uneasiness on the part of people today to go and go to a restaurant and eat food because of the fact that social distancing. And but this is something which will pass. For example, malls have opened in Mara. I'm talking specifically Mumbai. Malls have opened a month ago, and we are the footfalls that are being seen in these malls in the last 1 week, for example, were more by probably 15 or 20% compared to what it was in the previous week. That doesn't say much because it is still much lower than what it was earlier, but at least things are getting better. So my view is that as time passes, as people become more comfortable with the environment, with appropriate safeguards, everyone wearing masks and face shields and what have you, there will be more strength that we will see even in these stress sectors. The real estate sector was under tremendous stress, but has seen a little bit of a pickup in the last 2 or 3 months as more people you have used this as an opportunity to buy houses. So things are getting better. We still are nowhere near the end of the crisis. Hopefully, if the vaccine development is there, and let's say by April, May, we can pass on the vaccine to a reasonably large proportion of the people, that could go a long way in reviving confidence. We still have to go through the winter. We don't know what the winter month brings forth in terms of another wave of this virus. We do not know. We have no idea. We'll have to keep our fingers crossed and hope that we don't see another massive wave of the virus attacking us in the months ahead. But assuming that that does not happen, I believe that these sectors will take a much longer time to come out, but they will come out. Your second question on rupee appreciation. Look, rupee appreciation has to be looked at differently by importers and differently by exporters. India is a very large importer of oil, as you know. And with oil prices going down, we have been a big beneficiary. Higher or a weaker rupee will facilitate exports, make us more competitive from an export standpoint, but at the same time, a weaker rupee will mean that the cost of imports will become that much higher. So you got to balance the two. My sense is that ultimately you have to look at the inflation differential. If you're comparing the Indian rupee with the US dollar, you have to look at the pace at which the Indian economy, the inflation is there in India and inflation is there in the US. And typically, the difference between the two should represent the depreciation in the currency. That's fine.
Yeah, I think I agree completely. But my problem is that the interest differential today is getting distorted.
All right, I think we are coming to the end of our time, but let me ask one other question, which I think is there on several people's minds, and which usually gets thrown at most bankers, is still when do you think the low or benign interest rate regime will continue?
My personal view is still we see a pickup in inflation. The benign interest rate regime should continue. I have been a strong proponent of the belief that interest rates have bottomed out. I have said this in several interviews. I do not believe personally that at this point of time we will see further lowering of interest rates. So interest rates have probably bottomed out. A little bit here and there can happen because of a variety of issues, easy liquidity, and whatever steps RBI. But in terms of actual cuts in interest rates going forward, RBI might just do it once, and I say might just do it once, just to give a further spark to the economy. But otherwise, by and large, my view is that interest rates have bottomed out, but we should remain at these levels for some degree of time. It's only when economic activity really comes back in a big way that you could start seeing some pressure on inflation, and that is a time you could start seeing interest rates going up again.
Thank you. Again, if I may just add, perhaps let's say even if interest rates don't come down further, I think there is still scope for some greater trickle-down transmission, which has not entirely happened. So maybe some of that might result in lower rates in the hands of people rather than there being a policy rate disruption. Mr. Mistry, it is unfortunately time to conclude. There were more questions still, but I must tell you that we had great attendance. As I said, you have a fan club out there because we've had more than 200 people on Zoom, and there were almost 500 people following us on different media, whether it is Facebook or YouTube, etc. So we have to, like, you've been very optimistic and positive in this interaction about the economy. In a modest way, I can say this technology or this COVID has brought about greater participation because people can now sit in their homes or in different countries, perhaps, and participate in events like this. Thank you very much for your candid but well thought out and well reasoned, if I may say, remarks. What I am taking away personally is your optimism. And as you said, the construction sector and the real estate sector is one of the major engines of growth because it affects and impacts, you said, more than 270 industries. Same with the auto sector, by the way. And if we can focus on some of these to really kickstart or bring back the economy, it will be good. I just want to quote a couple of things which you said for the benefit of all our participants. You emphasize the fact that the worst is behind us, and you've said this on several occasions. And the other thing is that you think that the recovery has been faster than anticipated in many areas. And you also emphasize the issue of the need to continue with reforms. And as I said, leave money in the hands of people. So I think these are very, and your repeated emphasis on jobs. So I think these are very powerful messages. I'm sure all of us together as business people, as people interested in the economy and as citizens, will be able to craft a constructive way forward. And I also hope that the government is listening in on this. So thanks once again, Mr. Mistry, for this great session. Rekha, any further?
No, but I just want to thank Mr. Mistry for accepting our invitation. It's been great to have you here. And I hope we'll have you on other AIMA platforms very soon. And I just want to apologize to all the others. We couldn't take all the questions, but hopefully we'll get a chance to meet Mr. Mistry again. And it's been a wonderful evening. And I thank you all for attending and encouraging us to take this series forward. So with these words, thanks a lot, Mr. Mistry. Thanks a lot, everybody, Mr. Singhania, for joining us. And we can close the session now.
Good.
Thank you, Mr. Thank you, Rekha.
Thank you. Bye-bye.
Bye-bye.
Bye.